Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Good morning, Will. How are you?
I'm doing well. Mizzou over the weekend they got that big win, and I guess the new guys I'm supposed to be rooting for they beat Notre Dame as well. So
Yeah, they had a big win. Hey, I tell you, the nice thing about Mizzou football playing on Thursday night was I went to the game Thursday night, had a wonderful time, but then I got all day Saturday to watch football. I didn't have to go anywhere. I got to sit there and watch football all day. So I'm kind of a big fan of my team playing on a non-Saturday event. So big fan.
well, so what's going to happen this coming weekend? K-State guy, now Mizzou guy. What's going to happen when those
I
two?
don't want to talk about it. We're just not going to talk
We're
about
not
it
going to
today.
talk about it.
Yeah, I'm excited. I'm heading out to Manhattan for the game. I'm very excited about this rivalry coming back. These regional games are fun, and it's not really. I guess it's not coming back. It's a two-game series. One game there, and the next year K State comes here. But certainly excited to see these regional games kind of come back and play. So.
All right. Well, I'll send you a lifeline. I don't want you to, step on your tongue and get in trouble with either fan base. So, look, what are we seeing from the past week on the commodity market side?
Yeah, so September is kind of when we make the transition away from reporting old crop commodities because a lot of grain elevators also start using the new crop corn adjusted for an old crop basis. So we're just going to report new crop or old crop, however you want to look at it, corn prices. So for December corn, down 6 cents to $6.65. November soybeans also down 6 cents to 14.05. Those soybean oil components, soybean oil was down just over a cent per pound to 66 cents and a half per pound. Soybean meal was down almost $20 to $414.10 per short ton. Old crop wheat for December down 26 cents to 8.14, and then new crop wheat for July of 23 down 12 cents to $8.41.
So, what really led us into these changes coming into this week? What were the highlights?
Yeah, sure can. So, U.S. weekly ethanol production was down 5 million gallons last week to 285 million gallons. This utilized approximately 96 million bushels of corn. Last week, we got the oilseed crush report for July. It reported that we crushed 181 million bushels. That compared to 174 million bushels in June, and also was up from the 166 million bushels last July. U.S. soybean crush was extremely strong this past winter. The oil extraction rate increased in July from June. We also got the grain crush numbers. Corn consumed for fuel, alcohol, and other food and industrial uses came in at 500 million bushels in July. That was up 1% from June, but down 1% from July of 2021. Export sales reports continue to be delayed as USDA works through their new reporting platform. They do expect to have regular reporting resume on Thursday, September 15th. However, we do get daily flash sales. They do continue. These are the sales that are over 100,000 metric tons. In the last 6 trading days, nearly 59 million bushels of soybeans have appeared in daily export sales. Sales are split evenly between China and unknown destinations. Looking at managed money, open interest futures and options contracts for Chicago soft and hard winter wheat was flat on the week, while Chicago corn open interest declined 7%, and soybean open interest declined 6.1%. Managed money positions were up 40,000 positions, the largest since January of this year. That was corn. Managed money positions for soybeans and wheat were down. USDA's Economic Research Service projects U.S. farm income to grow $7.3 billion in 2022 to $147.7 billion. That's a new record in nominal terms and the second highest, only behind last year in real dollars. The Russian Agriculture Development Agency, designed to promote bilateral trade and investment in the agriculture sector with China, primary commodities targeted for increased trade and production were soybeans, wheat, corn, and meat products. And then the start of the month brings a whole bunch of private estimates for U.S. corn and soybean yields. The theme last week was shrinking U.S. corn crop and a growing U.S. soybean crop.
All right, so a lot of moving parts right there. And before we really dive into the main topic today, I want to, talk about a quick elephant in the room: continued lack of export sales reports coming out of USDA. Maybe a little bit of blindness there. But does that offer any opportunity for trade partners to maybe purchase some grain without fear of that driving up prices?
Well, we're still reporting the daily flash sales, and they still do have to report. So they are reporting. It's just not the weekly estimates coming out. So I do think that the market, is tracking this, and certainly is providing, market signals. We're just not getting those reports to come out to say how much is going where, who's buying what, how much of unknown, or how much is left to be shipped. So we're just not getting those. And then we don't have export inspections because we're recording this on Tuesday morning. And because of the holiday, Labor Day holiday, export sales won't come out until later, or excuse me, export inspections won't come out until later this morning. So just not a lot of export data this week due to those factors.
Right. So you still get to read the book, you just don't get the summary at the end,
That's right. That's right.
All right. Well, talking about some other global factors impacting the global market. Looking at South America, we're getting a better outlook or better vision into what their production is looking like. So, how is that affecting the global market? What does the picture look like with the production they're having down there?
Yeah, so we're at the start of Brazil's planting season, if you want to think about that, and so it's kind of a nice way to kind of start thinking about what could be produced in South America. USDA's counterpart in South America, I don't know if they're called the counterpart, but the USDA version in South America is CONAB. They released their production forecast for 2022-23 soybean production in Brazil. They reported a 3.5% increase in soybean planted acres. Assuming a trend line yield, that would imply a massive 150 million metric ton soybean crop, roughly 5.5 billion bushels of soybeans. That's nearly 1 billion bushels larger than the U.S. soybean crop, and up 900 million bushels from this past year, where drought kind of, it's like took some of the top end off. It wasn't as bad as the year before, but it certainly took some of the top end off. Private forecasting agencies are even a little bit more aggressive. Consulting firm Safaris projects 154 million metric tons, so up 4.5 million metric tons from CONAB. StoneX projects 153.6 million metric tons. So both a little bit larger than those government agency forecasts. Still, when you look at what's driving some of this, yield estimates, which again, South America was plagued by drought this last year that took the top end off the soybean forecast, really hurt their corn crop. On the soybean side, yields are expected up 20% year over year to almost to a little over 3.5 million metric tons per acre. So planting will begin soon here, as soon as weather permits, after September 15th. And certainly, I think we're expecting to see bigger soybean acreage, higher yields, more export potential out of the South American soybean crop.
So, what are your expectations for traders as they digest these reports and expectations coming out of these private estimators and government bodies? How do traders really respond to this? Does the market try to take that into account, looking down the line on a lot of these futures contracts, or is it really, okay, this could be a possibility, but we need to see, the weather play out? And there's obviously a lot of things that have to happen before that crop gets harvested.
No, absolutely. Where it's playing out right now is in spreads. So the difference between trading contracts before South American's production comes online in February, March, and after it comes online in February and March, right? So, if the trade continues to expect a large crop, which they are at the moment, we continue to see this spread difference of nearby contracts, even in the face of a U.S. harvest, trading at a premium to those that would be after the South American harvest comes in. I've been using the phrase that it's a lot like Groundhog Day, because this is a very similar outlook that we were talking about a year ago in September. A massive soybean crop out of South America. All the signals were pointing towards, they were going to increase acres, the yields were going to be strong. And then we had La Nina that created drought in South America really impacted their corn crop. Took this 1.2 billion bushels out of their soybean crop out of all of South America. And so in a way, this is a little bit like last year, projecting a major crop, but weather's going to dictate a lot of this. But as of right now, to answer your question, traders are anticipating a big crop out of South America. And certainly that would, right now the expectation is that Brazil could export a record 100 million metric tons of soybeans out of the country. So that would eclipse that 100 million metric ton mark for the first time, and kind of be a shift, I think, for the market if we did hit that 100 mark.
Well, maybe looking away from production and more toward consumption. China, here in the near term, at least, they're continuing to have COVID shutdowns and lockdowns. How's that impacted maybe their buying habits? How's that maybe impacted things like soybean processing and things like that?
Yeah, so certainly saw some more COVID cases pop up in the Chinese market, encourage less consumption of meat products as they have limited mobility in parts of the country. I mean, it's a factor as well as the Chinese economy. It's dragging, and as a result, we've seen some shift in buying habits that we would normally see in what we would call a recession, if you will. People moving away from the meat products, higher value proteins into other substitutes. And I think that's part of the reason why we've seen in the past, this divergence of feed margins for pigs and then the pork output. It got a little bit better. We saw China come in and buy some soybeans off the global market. The concern is, does that feeding margin hold as we move through the next couple months?
So, and then I guess looking internally also, we have some USDA reports that are maybe impacting or could be impacting the market here in September. So USDA farm income. First off, what are your expectations for, I guess, reactions to those reports? Do they have much, I guess, drive and sway within the markets?
Well, certainly. I think the trend is continuing. That USDA's first initial estimate for farm income is always the most conservative, that it tends to grow. And that was certainly a trend we saw this year as well. An expectation that farm income in 2022 was revised higher. And that was in the face of even a revision up in production expenses across the board. Now, this is broad from the standpoint that not everybody is going to be seeing as rosy of conditions as what USDA's farm income forecast would suggest. But to come in with the highest nominal value and second highest on record for net farm income, that certainly speaks to the strength of commodity prices, given that government payments were down substantially this year from last year, or expected to be down substantially this year from last year. We saw the big increase in cash receipts, up 23% in soybean revenue, up 10% in corn, up 26% in wheat receipts. Sales of animal products were also up an expected 28%. So, I look at these and I say, certainly we've seen strong prices and they've held a lot higher for a lot longer than many people would have anticipated. I would remind you, last time USDA put out their forecast, that was prior to the conflict in Ukraine. And so, you're seeing part of that also play in here. But, the end result, and I guess the take home message, is farmer debt to asset levels continue to decline, down to just under 13% in 2022. Working capital, the amount farmers have to spend on things to finance their operations, is expected to be 2.6% lower this year than last. So what does that mean? That means that farmers are using this extra money to pay down debt, and they're not holding it in cash reserves or cash supplies. And that's not a bad thing. As an economist, that's exactly what I would recommend: work to pay down debt, to get that off your balance sheet. So.
All right. Well, looking forward to the rest of this week. It's a little bit of an odd week because of the holiday that limited action on Monday, so everything kind of gets delayed. So, what reports should traders really be looking at for the rest of this week?
Yeah. So by the time this comes out, export inspections would have happened, but those will come out on Tuesday of this week. Crop progress will also be this afternoon to get a better update on the conditions out across the country. Thursday, we'll have the ethanol report come out at 9:30 a.m. from the Energy Information Agency, and then Friday, that Commodity Futures Trading Commission commitment of traders data to get an idea of where money's flowing in and out of the commodity sector.
All right, so some things to keep in mind there for traders. Again, keep an eye on those reports that come out later on Tuesday, because we did not discuss those. So if there's anything else that you'd be interested in, as a viewer, please check us out at brownfieldagnews.com to learn more on the livestock side. You can look up the weekly livestock market update with Megan Grebner and Scott Brown. Ben, thanks for joining me this morning. I'm Will Robinson on Brownfield.